Welcome, everyone. Thank you for joining us today. I'm Kenny Burch, a tax director at Richey. I'm joined by Gina Jackson, a tax partner in our mortgage banking practice. Today, we will discuss some options for attracting and retaining talent through equity-based compensation and deferred compensation arrangements. We'll walk through the major tools companies often consider: stock options, restricted stock units, capital and profits interests, and non-qualified deferred compensation. Gina, to start us off, what are some high-level questions a company should ask themselves when looking at different options?
Hi, Kenny. Yes, let's jump in. The first question a company should ask itself is, what type of entity are you? Are you a C corporation, S corporation, partnership, LLC? In general, S corporations can do stock options or restricted stock, just like C corporations, but extra care must be taken to avoid anything that creates a second class of stock or causes ineligible shareholder problems. And next, you should consider if the company is looking to give up equity or not. Timing of ownership, that's also an important one. Are you looking to give up immediate ownership, delayed vesting, or not give up ownership at all? And who are the eligible recipients? Are awards limited to employees, or will consultants, independent contractors, or other non-employees participate?
Thanks, Gina. That was a great way to set the stage. Let's move to stock options. What is a stock option at the most basic level?
A stock option is really just the right to buy a specified number of shares at a fixed price in the future. The incentive's pretty straightforward. If the company's fair market value rises above the exercise price, then the option holder can benefit from that increase in value. Options are especially useful when a company wants to reward future growth rather than transfer current value. If the company value does not increase, then the option may have a little less or no economic benefit. And if the value increases significantly, the option can become a meaningful retention and incentive tool.
And stock options generally come in two categories, right?
Yes, the major categories are incentive stock options and non-qualified stock options. The key differences involve who can receive them, how they're taxed, how flexible they are, and whether the company gets a deduction.
All right. Next, let's discuss incentive stock options, or ISOs. Gina, why do employees often like ISOs?
Yeah, ISOs can provide a favorable tax treatment for employees. The employee generally does not recognize taxable income at grant or exercise, and instead, tax is generally created when the stock is sold, and the gain will be capital gain.
That makes sense. What are the main ISO requirements or characteristics that people should know about?
Yeah, the main requirements are that ISOs can be granted only to employees. The exercise price generally must be at least fair market value at grant, and ISOs are limited to $100,000 of value each year.
Okay. What about payroll taxes and how the employer takes a deduction?
Yeah, ISOs generally are not subject to payroll taxes, but there is a trade-off. The company generally does not receive compensation deduction unless there's a disqualifying disposition, which we won't really get into today.
Okay. Now let's compare non-qualified stock options, or NSOs. Why might an employer prefer NSOs over ISOs?
Non-qualified stock options are generally more flexible for employers. They can be granted to employees, consultants, independent contractors, and other service providers, and they're not subject to the $100,000 ISO limitation. And the plan can be designed with more flexibility.
Okay, that's great. How are those NSOs taxed?
If an NSO does not have a readily ascertainable fair market value at grant, which is pretty common for closely held companies, there's typically no tax at grant. At exercise, there is compensation to the recipient for the amount by which the stock's fair market value exceeds the exercise price. For employees, that compensation income is generally subject to employment taxes, and the company generally receives a corresponding deduction. And then later, when the stock is sold, additional appreciation or loss is generally treated as capital gain or loss.
Okay. So it seems like the trade-off is really employee tax preference versus the flexibility that an employer might have.
Exactly. ISOs may be better from an employee tax perspective if all requirements are met, but non-qualified stock options are often easier to design and administer, especially where awards will go to non-employees or where the company wants a deduction.
All right. Let's shift from options to restricted stock. How does restricted stock differ from stock options?
With restricted stock, the company actually issues stock upfront, but the stock is subject to vesting or forfeiture restrictions, and that is a difference from an option, which is only a right to buy stock later. Restricted stock can still have value even if the company's value later declines because the recipient receives actual equity rather than a right that only has value if the stock price exceeds an exercise price.
I know these usually have vesting conditions. What are the typical vesting conditions, Gina?
Yeah, vesting might look to things like the passage of time, continued employment, or achievement of a specific performance goal.
That makes sense. How is restricted stock taxed?
The employee generally has no income at issuance unless an 83B election is made. And an 83B election, in simple terms, is basically the recipient saying, tax me now on the current value, even though the stock has not vested yet. If an 83B election is made, there is compensation for the employee based on the stock's current value, but future value growth will be capital gain to the employee. And care should definitely be taken when making an 83B election. If the value of the company decreases or the employee leaves before vesting, the employee may be stuck with a capital loss that they can't use. But the 83B election may be attractive when, say, the stock value at grant is low, the recipient expects significant appreciation, the recipient is likely to satisfy those vesting conditions, and the recipient can afford the upfront tax cost. It's also worth mentioning that there are also restricted stock units, which act very similar to restricted stock. RSUs are a contractual promise to deliver stock in the future and doesn't confer immediate ownership and therefore no 83B election decision.
Thanks, Gina. Seems like an important distinction for lenders to know. Now let's move on from corporations to partnerships and LLCs. What are some of the options of issuing ownership in a partnership or an LLC?
The two main options with a partnership or LLC are issuing a capital interest or a profits interest.
Okay. Maybe we start with the capital interest. What happens when a service provider receives a capital interest?
Yeah, a capital interest provides immediate ownership and existing value of the partnership, meaning if the partnership was liquidated after the issuance, then the owner of the capital interest would receive some value. Since there is current value, it is taxable to the recipient upon issuance and generally deductible as a guaranteed payment.
All right. Maybe talk about how that differs from a profits interest.
Yeah, a profits interest is designed to give the recipient no share of current liquidation value, but a share of future appreciation and profits.
All right. Why do businesses like profits interests?
They're popular because they can preserve that historic value for existing owners while giving key people upside in future growth. The prior owners retain the value built before the grant, and the recipient is incentivized to help create additional value. Because there's generally no current value at issuance, there is generally no tax to the recipient at grant. However, oftentimes a protective 83B election is considered.
All right. There's downsides to everything. What are some of the downsides to a profits interest?
Yeah, profits interest can be administratively complex. The company must track future value versus past value, and that gets harder if profits interest are issued on multiple dates. And a keynote here is that granting either of these types of interests could impact the classification of the individual as a partner versus employee, which definitely has implications on how compensation is reported.
All right. Let's move over and talk about non-qualified deferred compensation. Can you tell us what that is?
Absolutely. At a high level, non-qualified deferred compensation is an arrangement that defers payment of compensation earned in one tax year to a later tax year, outside of qualified plans like 401k plans and outside certain bona fide benefit arrangements. These plans can be useful for executives and key employees because they're not subject to the same non-discrimination rules as a qualified retirement plan. They can be limited to a select group of management or highly compensated employees, and they can be more flexible than other strategies to align to specific needs.
Why would a company use a non-qualified deferred comp plan as a retention tool?
Yeah, these types of plans can align long-term incentives without a current cash outlay. So the company is essentially making an unsecured promise to pay compensation in the future, so it may actually increase current cash availability while still offering a meaningful benefit. The flip side is that the deferred compensation generally remains subject to the claims of the company's creditors.
And then what are the rules under 409 Cap A require, maybe in just the most practical terms?
Yeah, Section 409A requires a few things, and it is highly complex. A written plan is required to defer compensation, and it has multiple layers. So the participant generally must make a timely election to defer compensation. The plan must specify those payment dates or events that are objectively determinable and non-discretionary at the time of deferral. Payments generally may be made only at fixed dates or on a schedule or upon a specified event, such as separation from service or death or disability, changing control, or even an unforeseeable emergency. And lastly, accelerating payments is generally prohibited except in limited circumstances.
Okay, and what happens if a plan fails 409 Cap A?
Great question, Kenny. The consequences can be severe. If a plan fails, deferred amounts may become currently taxable to the extent vested and not previously included in income. The participant may also owe interest and a 20% additional tax. The employer may also face payroll tax and reporting issues. And, these failures can cause employee retention issues as the employee faces a direct tax impact, even though it was the employer's error.
Thanks, Gina. You covered a lot of great information. To close us out, I think the most important takeaway is that there are multiple options to attract and retain talent. We'd encourage you to talk through these types of structures with Richey May or your tax advisors. They're highly complex, but often worth the investment. If you have any questions, please reach out to us at info@richeymay.com.